What is fixed income? Fixed income broadly refers to those types of investment security that pay investors fixed interest or dividend payments until their maturity date. At maturity, investors are repaid the principal amount they had invested. Government and corporate bonds are the most common types of fixed income products. Unlike equities that may pay out no cash flows to investors or variable income securities where payments can change based on some underlying measure, such as short-term interest rates, the payments of a fixed income security are known in advance and remain fixed throughout. In addition to purchasing fixed income securities directly, there are several fixed income exchange-traded funds, TFs, and mutual funds available to investors. Key takeaways. Fixed income is a class of assets and securities that pay out a set level of cash flows to investors, typically in the form of fixed interest or dividends. Government and corporate bonds are the most common types of fixed income products. They are known as fixed income because they pay a fixed interest rate credited to investors. At maturity for many fixed income securities, investors are repaid the principal amount they had invested in addition to the interest they have received. In the event of a company's bankruptcy, fixed income investors are often paid before common stockholders. Understanding fixed income. Fixed income. Investopedia Mira Norian. Companies and governments issue debt securities to raise money to fund day-to-day operations and finance large projects. For investors, fixed income instruments pay a set interest rate return in exchange for investors lending their money. At the maturity date, investors are repaid the original amount they had invested, known as the principal. For example, a company might issue a 5s bond with a $1,000 face or par value that matures in 5 years. The investor buys the bond for $1,000 and will not be paid back until the end of the 5 years. Over the course of the 5 years, the company pays interest payments, called coupon payments, based on a rate of 5 per year. As a result, the investor is paid $50 per year for 5 years. At the end of the 5 years, the investor is repaid the $1,000 invested initially on the maturity date. Investors may also find fixed income investments that pay coupon payments monthly, quarterly, or semi-annually. Fixed income securities are recommended for conservative investors seeking a diversified portfolio. The percentage of the portfolio dedicated to fixed income depends on the investor's investment style. There's also an opportunity to diversify the portfolio with a mix of fixed income products and stocks, creating a portfolio that might have 50 in fixed income products and 50 in stocks. Treasury bonds and bills, municipal bonds, corporate bonds, and certificates of deposit, CDs, are all examples of fixed income products. Bonds trade over the counter, etc., on the bond market and secondary market. Types of fixed income products. As stated earlier, the most common example of a fixed income security is a government or corporate bond. The most common government securities are those issued by the U.S. government and are generally referred to as Treasury securities. Fixed income securities are offered by non-U.S. governments and corporations as well. Here are the most common types of fixed income products. Treasury bills, T-bills, are short-term fixed income securities that mature within 1 year that do not pay coupon returns. Investors buy the bill at a price less than its face value, and investors earn that difference at maturity. 1. Treasury notes, T-notes, come in maturities between 2 and 10 years, pay a fixed interest rate, and are sold in multiples of $100. At the end of maturity, investors are repaid the principal but earn semi-annual interest payments until maturity. 2. Treasury bonds, T-bonds, are similar to the T-note, except that it matures in 20 or 30 years. Treasury bonds can be purchased in multiples of $100. 3. Treasury inflation. Protected securities, TIPS, protect investors from inflation. The principal amount of a TIPS bond adjusts with inflation and deflation. 4. A municipal bond is similar to a treasury since it is government issued, except it is issued and backed by a state, municipality, or county instead of the federal government, and is used to raise capital to finance local expenditures. Muni bonds can have tax-free benefits to investors as well. 5. Corporate bonds come in various types, and the price and interest rate offered largely depend on the company's financial stability and its creditworthiness. Bonds with higher credit ratings typically pay lower coupon rates. Junk bonds, Also called high-yield bonds, are corporate issues that pay a greater coupon due to the higher risk of default. Default is when a company fails to pay back the principal and interest on a bond or debt security. A certificate of deposit CD is a fixed income vehicle offered by financial institutions with maturities of less than 5 years. The rate is higher than a typical saving account, and CDs carry FEATS or National Credit Union Administration (NCUA) protection. 7. Traditional portfolio theory claims that an efficient investment strategy attempting to balance risk and returns should diversify in stocks and bonds. Stocks tend to be riskier with higher potential returns, while fixed income securities are safer with usually lower returns. How to invest in fixed income. Investors looking to add fixed income securities to their portfolios have several options. Today, most brokers offer customers direct access to a range of bond markets from treasuries to corporate bonds to munis. For those who do not want to select individual bonds, fixed income mutual funds, bond funds, give exposure to various bonds and debt instruments. These funds allow the investor to have an income stream with the professional management of the portfolio. Fixed income ETFs work much like a mutual fund, but may be more accessible and more cost-effective to individual investors. These ETFs may target specific credit ratings, durations, or other factors. ETFs also carry a professional management expense. Fixed income investing is generally a conservative strategy where returns are generated from low-risk securities that pay predictable interest. Since the risk is lower, the interest coupon payments are also usually lower as well. Building a fixed income portfolio may include investing in bonds, bond mutual funds, and certificates of deposits, CDs. One such strategy using fixed income products is called the laddering strategy. A laddering strategy offers steady interest income through the investment in a series of short-term bonds. As bonds mature, the portfolio manager reinvests the return principal into new short-term bonds, extending the ladder. This method allows the investor to have access to ready capital and avoid losing out on rising market interest rates. For example, a $60,000 investment could be divided into 1-year, 2-year, and 3-year bonds. The investor divides the $60,000 principal into 3 equal portions, investing $20,000 into each of the 3 bonds. When the 1-year bond matures, the $20,000 principal will be rolled into a bond maturing 1 year after the original 3-year holding. When the second bond matures, those funds roll into a bond that extends the ladder for another year. In this way, the investor has a steady return of interest income and can take advantage of any higher interest rates. Advantages of fixed income. Income generation. Fixed income investments offer investors a steady stream of income over the life of the bond or debt instrument, while simultaneously offering the issuer much-needed access to capital or money. Steady income lets investors plan for spending, a reason these are popular products in retirement portfolios, relatively less volatile. The interest payments from fixed income products can also help investors stabilize the risk, return in their investment portfolio, known as the market risk. For investors holding stocks, prices can fluctuate, resulting in large gains or losses. The steady and stable interest payments from fixed income products can partly offset losses from the decline in stock prices. As a result, these safe investments help to diversify the risk of an investment portfolio. Guarantees. Also, fixed income investments in the form of treasury bonds, T-bonds, have the backing of the U.S. government. 8. Corporate bonds, while not insured, are backed by the financial viability of the underlying company. Should a company declare bankruptcy or liquidation, bondholders have a higher claim on company assets than do common shareholders. 9. Moreover, bond investments held at brokerage firms are backed by the Securities Investor Protection Corporation, SIPC, up to $500,000 coverage for cash and securities held by the firm. Fixed income CDs have Federal Deposit Insurance Corporation, FDIC, protection up to $250,000 per individual. 6. Fixed rates are great to reduce risk, but once you're locked in, you can't increase the rate. During inflationary periods, fixed income securities are less favorable as the rate you've locked into in the past is likely less than the current rate of return for new bond issuances. Risks associated with fixed income. Although there are many benefits to fixed income products, as with all investments, There are several risks investors should be aware of before purchasing them. Credit and default risk. As mentioned earlier, treasuries and CDs have protection through the government and FDS. 6. Corporate debt, while less secure, still ranks higher for repayment than do shareholders. When choosing an investment, take care to look at the credit rating of the bond and the underlying company. Bonds with ratings below BBB are of low quality and considered junk bonds. 10. The credit risk linked to a corporation can have varying effects on the valuations of the fixed income instrument leading up to its maturity. If a company is struggling, the prices of its bonds on the secondary market might decline in value. If an investor tries to sell a bond of a struggling company, the bond might sell for less than the face or par value. Also, the bond may become difficult for investors to sell in the open market at a fair price or at all because there's no demand for it. The prices of bonds can increase and decrease over the life of the bond. If the investor holds the bond until its maturity, the price movements are immaterial since the investor will be paid the face value of the bond upon maturity. However, if the bondholder sells the bond before its maturity through a broker or financial institution, the investor will receive the current market price at the time of the sale. The selling price could result in a gain or loss on the investment, depending on the underlying corporation, the coupon interest rate, and the current market interest rate. Interest rate risk. Fixed income investors might face interest rate risk. This risk happens in an environment where market interest rates are rising and the rate paid by the bond falls behind. In this case, the bond would lose value in the secondary bond market. Also, the investor's capital is tied up in the investment, and they cannot put it to work earning higher income without taking an initial loss. For example, if an investor purchased a 2-year bond paying 2.5 per year and interest rates for 2-year bonds jump to 5, the investor is locked in at 2.5. For better or worse, investors holding fixed income products receive their fixed rate regardless of where interest rates move in the market. Inflationary risks. Inflationary risk is also a danger to fixed income investors. The pace at which prices rise in the economy is called inflation. If prices rise or inflation increases, it eats into the gains of fixed income securities. For example, if fixed rate debt security pays a 2 return and inflation rises by 1.5, the investor loses out, earning only a 0.5 return in real terms. Fixed income pros and cons. Pros. Steady income stream of fixed return. More stable returns than stocks. Higher claim to the assets in bankruptcies. Government and FDC backing on some. Cons. Returns are often lower than other investments. Credit and default risk exposure. Susceptible to interest rate risk. Sensitive to inflationary risk. Some government bonds like Treasury inflation. Protected securities tips are indexed to changes in the inflation rate and protect investors accordingly. Fixed income analysis. What to consider. When deciding which of these financial products to invest in, investors perform fixed income analysis. The techniques below are used to evaluate which investments make best sense for the investor's risk appetite and expected returns. Fixed income analysis often begins with risk. All investments have a relationship between its risk and its return. All else equal, an investment's returns should be higher when the investment is riskier. Therefore, fixed income analysis not only assesses whether an investor is comfortable with the level of risk they are taking on, but whether the level of risk is appropriate for a fixed income securities return. For fixed income securities, risk is tied to the creditworthiness of the issuing company, length of the fixed income security, and industry in which the company participates in. For example, you'll often find the lowest return fixed income securities related to the U.S. government. Because risk of default is low, U.S. bonds are often seen as safer forms of investments. On the other hand, corporations, especially ones with cash flow problems, may pose greater risk. Some fixed income securities offer periodic payments. This allows investors to recoup funds during the duration of the investment. This also reduces risk, as not all capital needs to be returned at the end of a potentially long bond term. Last, different fixed income securities have different features that make them more or less appealing. Some may be callable, where the debtor can repay the full bond prior to maturity. Other allows for the fixed income security to be converted to common stock. It's critical to consider what features are important to you, as each favorable term likely reduces yield. Example of fixed income. To illustrate, let's say PepsiCo Pepe issues fixed-rate bonds for a new bottling plant in Argentina. The issued 5 bond is available at face value of $1,000 each and is due to mature in 5 years. The company plans to use proceeds from the new plant to repay the debt. You purchase 10 bonds costing a total of $10,000 and will receive $500 in interest payments each year for 5 years. 0.5x $10,000. The interest amount is fixed and gives you a steady income. The interest amount is fixed and gives you a steady income. The company receives the $10,000 and uses the funds to build the overseas plant. Upon maturity in 5 years, the company pays back the principal amount of $10,000 to the investor who earned a total of $2,500 in interest over the 5 years. $500 x 5 years. What are examples of fixed income securities? Fixed income securities are debt instruments that pay a fixed rate of interest. These can include bonds issued by governments or corporations, CDs, money market funds, and commercial paper. Preferred stock is sometimes considered fixed income as well, since it is a hybrid security combining features of debt and equity. What is the difference between fixed income and equity securities? Fixed income securities are debt instruments that pay interest to investors along with the return of the principal amount when the bond matures. Equity, on the other hand, is issued in the form of company stock and represents a residual ownership stake in the firm, and not a debt. Equity does not have a maturation date, and while it may pay a dividend, makes no guaranteed payments to investors. In general, equity is a higher risk, higher return security than a company's bonds. How does inflation affect fixed income? Inflation will often have a negative effect on the value of fixed income securities when it leads to higher interest rates. This is because the prices of bonds and other fixed income securities are negatively correlated with interest rate changes. What is a fixed rate VIS? Variable rate bond? Fixed rate bonds pay the same interest rate over their entire maturity. These can be contrasted with floating or variable rate bonds, which periodically reset the interest rate paid based on prevailing rates in the market. The bottom line: fixed income refers to debt investments that pay a fixed rate of interest, along with the return of the principal loaned upon maturity. These include different types of bonds and certificates of deposit. Fixed income as an asset class is generally less volatile than equity, stocks, and is considered to be more conservative. A well-diversified portfolio should have some allocation to fixed income that becomes increasingly larger as one's time horizon shortens as retirement approaches. The basics of bonds. Bonds represent the debts of issuers, such as companies or governments. These debts are sliced up and sold to investors in smaller units. For example, a $1 million debt issue may be allocated to $1,000 bond. In general, bonds are considered to be more conservative investments than stocks and are more senior to stocks if an issuer declares bankruptcy. Bonds also typically pay regular interest payments to investors and return the full principal loaned when the bond matures. As a result, bond prices vary inversely with interest rates, falling when rates go up and vice versa. The bond markets are very liquid and active, but can take second seat to stocks for many retail or part-time investors. The bond markets are often reserved for professional investors, pension and hedge funds, and financial advisors. But that doesn't mean that part-time investors should steer clear of bonds. In fact, bonds play an increasingly important part in your portfolio as you age. And because of that, learning about them now makes good financial sense. In fact, having a diversified portfolio of stocks and bonds is advisable for investors of all ages and risk tolerance. Key takeaways. Bonds are debt securities issued by corporations, governments, or other organizations and sold to investors. Backing for bonds is typically the payment ability of the issuer to generate revenue, although physical assets may also be used as collateral. Because corporate bonds are typically seen as riskier than government bonds, they usually have higher interest rates. Bonds have different features than stocks, and their prices tend to be less correlated, making bonds a good diversifier for investment portfolios. Bonds also tend to pay regular and stable interest, making them well suited for those on a fixed income. What is a bond? When you purchase a stock, you're buying a microscopic stake in the company. It's yours and you get to share in the growth and also in the loss. On the other hand, a bond is a type of loan. When a company needs funds for any number of reasons, they may issue a bond to finance that loan. Much like a home mortgage, They ask for a certain amount of money for a fixed period of time. When that time is up, the company repays the bond in full. During that time, the company pays the investor a set amount of interest, called the coupon, on set dates, often quarterly. The main types of bonds are government, corporate, municipal, mortgage, treasury. Government bonds are generally the safest, while some corporate bonds are considered the most risky of the commonly known bond type. For investors, the biggest risks are credit risk and interest rate risk. Since bonds are debts, if the issuer fails to pay back their debt, the bond can default. As a result, the riskier the issuer, the higher the interest rate will be demanded on the bond, and the greater the cost to the borrower. Also, since bonds vary in price opposite interest rates, if rates rise, bond values fall. Credit ratings. Bonds are rated by popular agencies like Standard & Poor's and Moody's. Each agency has slightly different rating scales, but the highest rating is AA and the lowest rating is EIED, depending on the agency, or D, depending on the agent. The top 4 ratings are considered safe or investment grade, while anything below BBB for SIEP and BAA3 for Moody's is considered high yield or junk bonds. 1. Although larger institutions are often permitted to purchase only investment-grade bonds, high-yield or junk bonds have a place in an investor's portfolio as well, but may require more sophisticated guidance. Generally, governments have higher credit ratings than companies, and so government debts are less risky and carry lower interest rates. Pricing bonds. Bonds are generally priced at a face value, also called par, of $1,000 per bond. But once the bond hits the open market, the asking price can be priced lower than the face value, called a discount, or higher than the face value, called premium. 2. If a bond is priced at a premium, the investor will receive a lower coupon yield because they paid more for the bond. If it's priced at a discount, the investor will receive a higher coupon yield because they paid less than the face value. Bond prices tend to be less volatile than stocks, and they often respond more to interest rate changes than other market conditions. This is why investors looking for safety and income often prefer bonds over stocks as they get closer to retirement. A bond's duration is its price sensitivity to changes in interest rates. As interest rates rise, bond prices fall, and vice versa. Duration can be calculated on a single bond or for an entire portfolio of bonds. Bonds and taxes. Because bonds pay a steady interest stream called the coupon, owners of bonds have to pay regular income taxes on the funds received. For this reason, bonds are best kept in a tax-sheltered account like an IRA to gain tax advantages not present in a standard brokerage account. If you purchased a bond at a discount, you'll be required to pay capital gains tax on the difference between the price you paid and the bond's par value, normally $1,000 per bond, but not until the bond matures and you receive the face value of the bond. 3. Issuers of bonds, on the other hand, such as corporations, often receive favorable tax treatment on interest, which they can deduct from their taxes owed. Local governments and municipalities may issue debt too, known as municipal bonds. These bonds are attractive to some investors as the interest payments to investors can be tax-free at the local, state, and tax-free at the local, state, and or federal level. Issuers of bonds. There are 4 primary categories of bond issuers in the markets. However, you may also see foreign bonds issued by corporations and governments on some platforms. Corporate bonds are issued by companies. Companies issue bonds rather than seek bank loans for debt financing in many cases because bond markets offer more favorable terms and lower interest rates. Municipal bonds are issued by states and municipalities. Some municipal bonds offer tax-free coupon income for investors. Government sovereign bonds such as those issued by the U.S. Treasury. Bonds, T-bonds, bonds issued by the Treasury with a year or less to maturity are called bills. Bonds issued with 1 to 10 years to maturity are called notes. And bonds issued with more than 10 years to maturity are called bonds. The entire category of bonds issued by a government treasury is often collectively referred to as treasuries. Government bonds issued by national governments may be referred to as sovereign debt. Governments may also offer inflation-protected bonds, EEG TIPS, as well as small denomination savings bonds for ordinary investors. Agency bonds are those issued by government-affiliated organizations such as Fannie Mae or Freddie Mac. How to buy bonds. Most bonds are still traded over the counter, OTRA through electronic markets. For individual investors, many brokers charge larger commissions for bonds, since the market isn't as liquid and still requires calling bond desks in many buy and sell scenarios. Other times, a broker-dealer may have certain bonds in their inventory and may sell to their investors directly from their inventory. You can often purchase bonds through your broker's website or call with the bond's unique ID number, called the CUSIP number, to get a quote and place a buy or sell order. Alternatives to buying bonds directly. If you want the income earning power of a bond, but you don't have the funds or don't want to own individual bonds, consider a bond ETF or bond mutual funds. These are well-diversified funds that give you exposure to many different bonds and pay a monthly or quarterly dividend. Because some bonds have a minimum purchase amount, smaller investors may find these products more appropriate for their smaller amount of capital while remaining properly diversified. The bottom line: most investors, regardless of age, should have at least a small amount of their portfolio allocated to fixed income products such as bonds. Bonds add safety and consistency to a portfolio. Although there is a risk that a company may default and cause a large loss, investment-grade bonds rarely default. However, along with this safety comes a lower rate of return.